Alternative markets, your path to creating wealth. In this video, we introduce the alternative financial markets and explore how they can create substantial wealth for you much more quickly. In fact, these markets can provide you with passive annual returns of 50 to 100% or more in your portfolio. First of all, what are the alternative financial markets? They are 1. The Forex market, or currencies, and 2. The commodities market, or raw goods. Futures and options are a subset of the commodities market and represent just different ways to trade in that market. The futures market consists of contracts to buy commodities or financial instruments at a specific time. The options market consists of contracts to potentially, but not necessarily, buy commodities or financial instruments at a specific time. Let's understand these markets. First, what is the Forex market? Forex stands for foreign currency exchange and involves the exchange of one country's currency for another's. For example, investor A acquires 10,000 euros from investor B for $14,000 US. The Forex market was established in the 1970s and became popular with the globalization of the world's markets. This market is sometimes referred to as the market closest to the ideal of perfect competition. The Forex market is the largest and most liquid financial market in the world and includes trading between large banks, central banks, currency speculators, corporations, governments, and other institutions. The average daily volume in the global Forex and related markets is continually growing and was last reported to be over $4 trillion traded daily on a global basis. Second, what is the commodities market? The commodity market is the market where raw or primary products are exchanged. Examples are foods, grains, sugar, coffee, livestock, energy, metals, minerals, etc. Commodities have been exchanged throughout human history. It is probably the oldest industry there is, hence the use of the term market as the standard title for any commercial exchange. The earliest records come from Sumeria around 3000 BC, with the printing of sheep and goats on clay tokens and tablets. The modern commodity market started in the United States in the 1800s. These raw commodities are traded on regulated commodities exchanges in which they are bought and sold in standardized contracts. Why would you want to be involved in these markets? For the experienced expert who understands and trades these markets well, the return far exceeds anything a stock trader or real estate developer is able to achieve. True experts in this arena, the top 1%, average between 50% to over 100% annually and are able to do this consistently and verifiably for many years, some of them for decades. Even the Wall Street Journal has suggested that smart investors consider adding these products to their portfolio. Sounds impossible though, doesn't it? How can someone make these kinds of returns and nobody knows about it? Like we said earlier, the Forex market alone trades in the trillions of dollars daily. Just about every product you deal with on a daily basis, from food to clothing to energy, was involved in a commodity exchange at some stage in the game between harvesting or extracting some raw good from the earth and processing it down to a usable product. Many investors know about these markets and have made their fortune dealing exclusively in this arena, from individual traders up to large commodity exchanges. Banks especially deal heavily in currencies, and for many, over half their profits come from these trades. The simple reason you may not know about these markets or trust them is that they cannot be offered to you by traditional financial professionals. Because they fall mostly outside the jurisdiction of the SEC, traditional planners can't trade and especially can't make a commission on your involvement in these markets. It's as simple as that. How can the alternative markets offer a superior return in your portfolio? 1. These markets are far less regulated than the traditional markets, so much more of the profit is returned to you, the investor. Why is there less regulation in these markets? A. The financial instruments being traded, commodities and currencies, act as their own collateral. If a trader purchases 1 ton of corn, that trader owns 1 ton of corn, even if the value of that corn moves differently than expected. B. Accountants can't fake or inflate alternative market prices. There is no middleman to tell anyone what an asset is valued at. The market defines what a willing buyer is willing to pay for that asset. For example, Oil will sell at what someone will pay for it under current conditions. The buyer is fully aware of what they are purchasing and what the market will pay for it. A tangible product's value is almost impossible to fake. This whole idea is similar to a bank charging you 20% interest for a credit card purchase, but only 5% for a mortgage loan. The mortgage is backed by a physical asset, your house, so it is a much safer investment for that bank to make. 2. There are fewer startup and operating expenses to do business in these markets. Since the alternative markets are minimally regulated compared to traditional stocks and mutual funds, there are far fewer startup and operating expenses. Startup fees for a mutual fund can run in the millions, and operating expenses are an ongoing headache involving tedious reporting and hiring of independent accounting firms to validate operations. These fees are, of course, passed on to the investor and severely erode the brokerage's trading profits. 3. There are no corporate business expenses. When you buy a traditional stock or mutual fund, you're buying part of a company with all of its expenses and overhead diluting that company's profits. This includes fees for corporate offices, operating expenses, CEO salaries and bonuses, staff, managers, marketing, etc. In the alternative markets, you're buying a simple asset and the entire profit of a transaction are yours to keep. With a commodity or currency, you're receiving a final product after all the expenses and risks of delivering that commodity have been accounted for. It's as if you own stock in a company's end product, like the software that Apple or Microsoft creates, with all the corporate overhead it took to create that product taken out of the equation. 4. Trades can be heavily leveraged. This is similar to real estate, where $40,000 down can control a piece of property worth $200,000. A gain in value of 50% means that $200,000 property is now worth $300,000. That's a $100,000 increase on an initial outlay of just $40,000, or a true gain of 250%. The same occurs in the alternative markets. Your portfolio can control more assets than you actually have in your account to create substantial profits. Of course, in an aggressive trading strategy, a decline of 50% is also magnified if the trader is not protecting your principal with proven risk management techniques. Expert traders know how to limit risk and calculate the risk per trade that is suitable for your chosen portfolio. 5. Successful expert traders can make profits in both up and down markets. In traditional stocks, the market generally goes up or down as a whole. Microsoft stock usually doesn't go up when Apple goes down. They tend to move up or down together, depending on the economy and the industry. The ability to make successful trades in both up and down markets doubles the potential profits an investor can make. For example, if Intel goes up 20% one month and then loses 5% the next month, that's a net gain of 15%. A Forex trader could have profited 20% the first month, then an additional 5% the next month, for a net 25% gain if the same movement had occurred in the currency markets. How do you make sure you're not being scammed? We all see wild claims like this every day. You of course have to do your own due diligence, but this is difficult. The scammers know the system as well as any of us and know how to bury scam reports and move from con to con. For our own trading, we perform a high level of due diligence and background checks. We also leverage third-party companies that do rigorous verification and testing of their own regarding each trader they consider. Only 1 out of every 1,000 traders meet our criteria. How do we qualify the best traders and protect you in the process? 1. We are often able to obtain FBI-grade background checks against a potential trader to ensure a complete lack of criminal record. 2. A trader's results are verified against true brokerage statements to ensure that what the trader says they've accomplished is 100% accurate. 3. A trader must have verifiable trading results of at least 2 years, with many having decades of verifiable trading history. 4. Often we can find companies that we trust that have put up their own money with the trader and that monitors their results regularly to verify the accuracy and success of that trader over time. Only after about a year of background checking and testing will we advertise our results with the trader to interested parties. A scam can be perpetrated for only so long before the pyramid collapses. Historical verification of this depth and quality is how you ferret out the haves from the have-nots. As further protection and to be in full compliance with SEC regulations, a signal service is utilized to shield potential investors from fraud and embezzlement. Please see our video, The Beauty of Signal Services, to learn how this mechanism protects you from potential abuse. Thank you for learning more about these lucrative alternative markets. To find out how you can enjoy substantial profits in your own portfolio, please go to our site to learn more.